Yeah, Alex, what about this spray? About it?
What do you want to have? You're not.
Alex, what about this spring you want to show on this spring?
Can we show like the classic display instead of back here?
We wanna.
Yeah.
Wait till the plants on this.
Yeah, you can. So
I feel much better. I don't want to.
Hey.
This. Okay.
that's like yours. Thank you so much.
Yeah.
Okay, so I see students still are having some visas, but we'll start. That's okay, and then they'll sit in a few minutes. Because I mean we have a very special guest here today. Guys, I want to start, so if you can get in. We have a very special guest today, Sven Carlin. I got to know Sven through the YouTube channel and later on the book. And I can say I'm an avid viewer and subscriber. I'm one of 200,000 subscribers. So hopefully you make some a few bucks from that. And I know you donate it, so you'll tell us all about it later. But I'm very, very happy to have you here. We are CSIMA, this is the Investment Management Club in Columbia Business School. And we try to host, recognized investors and researchers and, to expose the students to your work and maybe give some inspiration. So Sven, very, very happy to have you. And tell us a little bit about yourself so the students can know you.
Well, thanks for having me. As you said, my name is Sven Carlin, and I have been investing since 2002. So I was even younger than most of you there when I started investing, and investing has been a passion of mine, and I continued to develop it through education, did a Ph.D. on the topic of risk analysis and investment. Later was assistant professor of finance and accounting at the International Business School of Amsterdam. Then, as you are a teacher, your summers are mostly free. And so I started sharing my stock analysis on Seeking Alpha, if you're familiar with that platform. From that, one thing led to another. I started sharing on YouTube, and since then also started my own research platform where I share my analysis. And that's pretty much it. For the last 6 years, I'm sharing my work on YouTube and sharing my research focused on value investing through my research platform.
It's amazing. Can you tell us a little bit more about the research platform?
So I started all my social media presence with research reports. I do the analysis, and then I try to summarize it in a way that a reader can grasp the risk and reward of an investment in the shortest time possible. So I do research, put it into a report, and every week I publish something, and people are following that, seeing how an investment fits their own portfolio.
Great. So, we are here in Columbia Business School where Buffett was a student of Graham, and it seems like, I mean, many investors say that it's part art, part science, and each investor has their own kind of philosophy or way of doing things, way of analysis, way of thinking about investing, and would really like to hear from you. Like, can you describe your own philosophy about investing?
My philosophy is pretty simple. I want to invest into something that is already creating value in some form, and then that it offers also the potential for that value to grow, and buy that at a fair price. For example, most of the students there are renting an apartment somewhere in New York, and that apartment is someone's investment. It's pretty simple, straightforward. You buy the apartment, you can finance it with a loan, and then you get the rent. Now, is it a good or bad investment? Depends on how much you are paying for that apartment and what's the yield on that apartment. That yield is the value creation over time. The growth would be increasing the rent alongside inflation, and that's a pretty simple, straightforward investment. I think that most of you would be very excited if you can get such an apartment in New York offering a 10% yield, but likely yields now are 3 to 4%, which means it isn't that attractive from an investment perspective because the value isn't that high. So I try to look globally for value investments where immediately the business is giving me dividends or growth, or investing in something, or has buildings or whatever that I'm sure that I will not lose money, which is the essence of value investing, and that on top of it I can see some growth long term, hopefully mispriced by the market.
Okay, so I think, as a viewer of your YouTube channel, I feel like I know a little bit more, a bit deeper than that. I mean, we all understand what it is, buying an apartment and buying things below its worth, and having a high yield. We all understand that. But I think you have a relatively unique approach. First of all, you're very candid in your research and your YouTube channels. And I want you to be, a little bit more of Sven that I know, and be a little bit more specific, about your strategy, how has it evolved? Because I know that you talk about, I want to go for 15% long-term compound, and so you do have this, goal in mind. And
Excellent.
I want to hear, if you can, about your philosophy.
So that's the starting point, is the apartment and the yield. But then if you want to do more, you need to go into psychology. You need to take advantage of market irrationalities. So what is a market irrationality? Now, the most hated market in the world is the Chinese market. If you look at the US market, the most loved company on the US market is Apple. I don't know exactly the number, but I think more than 20% of sales of Apple phones are coming from China. So on one hand, you have Apple extremely loved with exposure to China at crazy valuations. And on the other hand, you have Chinese companies trading at ridiculously low valuations. So that is a market irrationality. And if you want to make really good returns at some point in time, then it is much easier to make them with the irrationally mispriced cheap things rather than the very expensive things, like, for example, Apple at the moment. But you can see the irrationality of the markets because the markets love Apple. Copper prices aren't going down, which means that there is still demand from China, which means that people still build, live, and eat in China. So the market might be at the moment mispricing China, which creates a value opportunity in my perspective. And this cyclical, psychological sentiment opportunities is also something that I really like watching, based on that basic value investment, yield value creation that we started with.
Okay, so if I can push you a little bit more on that China thing, you know, at the end of the day, the thing is about risk-adjusted returns, and you mentioned irrationality, and so I guess the average person or the average investor would say, look, I don't want to invest in China because, you know, I fear from regulation, I fear from other stuff, and I see what they did to Jack Ma. I don't know if they found him or not, you know. So there is some risk there. So maybe the market is rational. So how would you respond to that?
There is risk, but it doesn't, there is something that is on the headlines, and that is something that happens in reality. So of course, if in a communist country, if you go and you start speaking against the government, you will get punished. But Jack Ma is back, and actually practically nothing that serious has happened. We are still doing business. You are still buying things, importing from China. The world is still moving. So yes, there is a risk, but compared to the cheapness, it is extremely cheap. And then if you have more of these cheaper situations, I don't know, 2 years ago, or already 4 years ago, oil was incredibly low, like we will never use oil again. And so you can have more of these bets. And if you have a few of them, for example, telecommunication stocks are also priced incredibly cheap. Verizon is offering a 7% dividend, and that's one of the most expensive ones. If you go to Europe, you have businesses with free cash flow yields of 15 to 20%. And that is another bet. And then of 5 bets in a portfolio, somewhere the risks will definitely materialize, but from the risks being there and materializing, there is usually a lot of profits that can be made.
Okay. So could you, as a follow-up to that, maybe describe us how does a perfect investment look like to you? Maybe with a specific example. I mean, I know that you bought Apple in 2016, but also sold it a year later, right? So maybe we'll talk about this a little bit more, because I see you really enjoy that. So tell us a little bit about it. About your perfect investment. Yes.
The perfect investment would be one that perfectly fits the risk and reward of an investor. For example, if you're a student now and you have a student loan at 9%, then it is smart to pay off that debt, because that is 9% at no risk. So that's a perfect investment for a student with a 9% interest rate. If students have interest rates of 0.1%, like they used to have in the Netherlands, I used to tell them never to pay back that loan. So it is always personal, because your money is there to improve your financial life. So the key is to find an investment that is perfect for a person. Saying that, for me, I love investments where I cannot lose money in the long term. So I need to have some assets, something of value, something that I know somebody will be happy paying a lot of money for, or more money than I am paying for. Thus, there needs to be something tangible. I like a business that also have cash flows and that it's trading at a cheap valuation. If I can find businesses with free cash flow yields at 10, 15, 20%, not at the moment, but across the cycle, that's a great investment for me.
So can you give us an example of such a business, of such an opportunity that you see now? It's not an investment advice, and don't worry about it. So, we are here for educational purposes. And
all right, so I think it's also the second largest investment in Seth Klarman's portfolio, and that is Liberty Global. So Liberty Global is traded in the US, New York Stock Exchange, but it is a European telecommunications stock. It has joint ventures, Virgin Media in the UK, Ziggo Mobile in the Netherlands. It has an operator in Switzerland and in Belgium. And the market capitalization now is around 7 billion, and they are making 1.5 billion in free cash flow per year that they are using to repurchase their shares. And in the last 14 months, they bought 20% of the company back.
Great. The valuation. So the question is why is it valued like that?
So first, you are having a value creation yield of around 15%. If you look at the value of the telecommunication companies, if they would sell one by one, then the value would quadruple of the market capitalization. They are this cheap because telcos have had huge capital expenditures over the last decade, and they never seemed to arrive at that money cash flow machines that they were promised. So the market sentiment was bad, but finally we see 5G capex going down, thus more cash flows. And these are big businesses. There is always something negative, a little bit slowdown here, increase there. But when you're looking at a company that buys back 20% of shares per year, you know that there is something of value. And the value is that we are using that communication at the moment as we speak. So the business will not go away for a while. And that's one of the investments, for example, I have.
So you have a lot of communication in your channel with subscribers and comments. And what is maybe one example of a name of a stock of a business that you see people talk about and it seems like it's overvalued and you don't, it seems like irrational to the other side, right? Because this telco, Liberty, is maybe irrational to the point of being very cheap. So what is very expensive in your mind currently in the market?
And the market always has these love stories. And at the moment, everyone is infatuated with AI and chips and semiconductors. So everyone thinks that for the foreseeable future, AI will be everything. And these chip companies will make a lot of money. And this reminds me a lot of the 2000 dot-com bubble when everyone thought the internet will take over and internet companies will make a lot of money. As we see now, you are in New York, I'm in Europe, we communicate practically for free. The internet did take over, but those dot-com companies didn't make as much money as the price was saying that those would. And so now with AI stocks, there is also the risk that those companies, especially if you know the semiconductor industry, the supply and demand there, it could be very easy that in 2 years there is oversupply and then nobody makes money and therefore the stock prices are too overvalued, let's say, for the risk and reward.
Right. So let's back off a little bit and try to be a little bit more theoretical here. And I'd like to ask you, when do you sell a stock? So I take you back to the Apple sale that you had. How would you describe? I mean, has it changed since then? Maybe you changed your philosophy about it. Well, when do you sell a stock?
When you need the money. So again, knowing when to sell is the most difficult question an investor can make. So because you are selling thinking that you can invest into something better, and then usually the stock that you are selling or did well and does even better. So it's very, very difficult to know when to sell something. But I have the genius sold Apple in 2017, bought in 2016. So who am I to speak about selling? But then I made good money on that trade, and then I thought, I'm a genius, let's sell, and confirm that I'm a genius. That now isn't so smart. But for example, I owned also another company which was a Norwegian solar company, Scatec Solar, and they had the business was to build these solar projects around the globe, charge for the building, and then have a contract with the country to produce electricity for 20 years. And that was a great business model. They made 15 to 18% on their projects, nothing wrong, globally diversified, financed by the Norwegian oil companies, so they had plenty of money. And then these guys go and buy some hydropower companies in Africa, paying billions for very, very low yields in the midst of the renewable boom. Now we have the AI boom. 2 years ago, we had the renewables boom that is now unfortunately over. So in 1 second, the business changed, and it was too expensive for what I thought it was good. And then I sold, and I did okay there because the stock crashed after that. So sometimes you win, sometimes you lose when you sell. But if I don't like something, or if I wouldn't buy it at that price, I'm okay with selling, and then wherever it goes, it's okay by me.
So maybe going a little bit deeper, I mean, how would you describe your research process? Because I know in terms of filtering, you said a few times, start with the A's, right? I think it's not your idea, but you took it from someone. But let's say you started with the A's and you got a company. How do you have some kind of checklist? What do you look for? When do you say, it's not interesting? How does this look like?
So you start with the A's, or usually an index, and then I start with the top companies. And then, as I said already, I have this company with a 15% free cash flow yield. So whatever is there that is not close to that is immediately eliminated, because I prefer owning that one rather than something else that doesn't create as much value. So that is already 99 of 100 eliminated. And then the second is, for example, now Asia is cheap, so I'm looking at, again, Asian companies, but then one by one. And there is this, it has a great stock ticker in Hong Kong, 0001, CK Hutchinson, which is, again, a global conglomerate, and the price to book value is 0.29. But the company owns retail in Europe, telecoms in Europe, global ports across the globe, doesn't have that much debt, has some cash flows. But then I analyze the whole business. If they would liquidate, you would make 4 times your money in a year. But they are a family-owned business, so not interested in liquidation. They pay a good dividend. I think it's 6%. And that is it. So yes, there is value. I made the research. Some people will find it interesting, but the dividend yield and the potential there without immediate catalysts. So you're looking for, okay, value, and then catalysts to unlock that value. And if there aren't any catalysts that I see there, and the yield is not 15%, but let's say 10%, then okay, I put it there, I put it on my covered stock list, and then follow it over time.
Okay, so to ask, the students that you see here are many of them, pursue investing. Some of them are newer students, some of them are second-year students doing the value investing program. We speak about investing all the time, and I want to push back a little bit and kind of tell you, and discuss it with you. It sounds like you like cheap stuff. It sounds like very simple. I'm looking for a 15% free cash flow yield, and that's where I start, which is reasonable. But the pushback would be, look, there is a reason why these things are cheap, and where is your edge? I mean, why do you think you got it right and the market got it wrong? So How do you think about this?
Because those businesses that are cheap, that I like, create value no matter what happens with the market. The market usually wants to get the money immediately. So there are no imminent catalysts with like this Asian business that I just mentioned. And the market loves a stock that goes up. That's it. And if a stock doesn't go up, then it goes down. I have never seen a stock trading flat. Only 3-month treasuries trade flat. Stocks either go up because people think a stock will go even higher, or it goes down because people sell that because it's going lower. And then there is so much sentiment in relation to real value. And then, for example, if I say China now, nobody says, oh, don't invest in China, oh, it risks this, that, left and right. But 2 years ago, everyone was so excited about Chinese stocks. And that's the sentiment. And I don't care when it will revert. Usually it reverts between 2, 5, 7 years. But in the meantime, those businesses are paying dividends, are growing, are investing, have a good yield that I like owning them as businesses. So I cannot know what the market will think, what the market will vote in the future, but I know the business, and if I would own the business, I would be a happy owner. So we have this feeling that we must buy a stock and then beat the market, outperform, but real investors buy something to own. As Warren Buffett says, his preferred ownership period is forever. And it's very hard to find such investments. Even Warren Buffett sells 9 out of his 10 investments.
Yeah, and you know, Buffett also said, I think that if he would manage a lower amount of money, then he would probably, his turnover would be quicker, and he would do like 50%, right? I mean,
yeah, that's what he did in his early years, like in the early 60s. So looking for value investments and then waiting for catalyst and trading them.
Yeah, so in some sense, I think that, correct me if I'm wrong, but it seems like Buffett has this problem that we all wish to have, right? Which is I'm too big and I need to make really big trades. And so his investment universe is very narrow. While maybe ours is different and maybe we could do things differently. And so I would try to ask you, like, what are some of the mistakes you see investors, retail investors, not professional investors, retail investors do?
Well, usually I get called an idiot in the comments. And whenever that happens, retail investors are on a really, really dangerous position. So when I started my YouTube, marijuana stocks were all over the place. And people thought that marijuana, everyone, you will be in class now and smoke marijuana and these businesses will make billions. Fast forward 6 years, nobody's even talking anymore about these businesses. So investors make the mistake of chasing that trend, even if there is no real value behind that. And I made an analysis, remember, on that marijuana, and it's the same as growing tomatoes. So you need a greenhouse, whatever, glass house, put in either marijuana plants or tomatoes, and that's it. And therefore, high competition. If you make money, it means nobody makes money. Family-run business, like a normal farming business. The family makes its money, and that's it. And every few years, you see these trends that people chase. I remember I was saying that Cathie Wood and ARK investment is too risky at the peak of their performance when she was compared as the new Warren Buffett. And I was saying how it is crazy to invest at these valuations in that global long-term projections. But everyone love that stories of eternal growth, a lot of money, and that's usually the biggest mistake investors make. They have some winners. So I've been saying that Tesla is too risky as a value investment since ever, and I have been clearly wrong from 2017 till 2021 on that. But that is the risk and reward. I don't think the risk justifies those investments. And even if you make 10 times your money on a stock like Tesla, if you continue investing on that risk and reward gamble, the next round of money, you will lose it.
Yeah, I mean, I think that's exactly the point. Sometimes it goes well for you, but it doesn't mean that the decision to make the investment in the first place was the right decision. That's always hard, you know, to look back and these people tell you, you know, we told you, and you feel like you missed it. But yeah, I think we understand that. And what are, you know, what kind of advice would you give? So many of the students here, they wanna pursue a career in investment management, which basically means, you know, managing money for other people in this way or another. What kind of advice or maybe tips could you give the students at this point?
So I am, let's say, a typical student as your students, because I also wanted to manage a fund. I loved investing. And then in 2013, I said, okay, I love investing. I'm finishing my PhD. I will move to London. I got a job at Bloomberg. And then I said, okay, let's go back to teaching. I will teach and I will try to set up a fund in the Netherlands. I even did set up a fund in the Netherlands and had even some clients, all made money, which is good. But then I closed it, I think, in 2018 because I didn't have enough volume to be an investment manager, not enough money. And that's also why I started YouTube, to share my research, to promote myself, and perhaps one day to start an investment management business. Then one thing led to another. My research was in high demand for it. And then instead of managing a business, managing money for other people, I just share my research. And I went that route, the social media, let's say, route, promoting, giving value through YouTube, saying this is what I do. If you want more, you can check what I do. So I don't manage money. I thought about setting up a fund. I even had a group of friends that would offer me 50 million to start with, which is a good amount to start the fund. I've looked everywhere. To manage properly an investment fund, it costs about 200,000 here in Europe, 200,000 per year, just the cost, administration, etc. And then I thought about it, but then you have also the pressures of constantly performing. If you look at the statistics, only 1 out of 7 investment funds that are started survives past 5 years. Usually those are liquidated, closed, because the managers cannot get to a scale enough to continue existing or justifying the existing and justifying the costs. So I think that as what you can do in the world of finance, today you have the red ocean, which is going through internships, working for the banks and trying to get a job somewhere with renowned investment manager, or you can do what I did and go the social media route, which is, let's say, you are much more free rather than working somewhere else. And I cherish my freedom above anything else. And that's why I stick to this route. I turned down many offers because I just wanted to be free, do what I like, when I like, how I want it, and hopefully in that way remain independent and create value for customers.
Yeah, no, that's very inspiring that you share your own kind of way of doing things. I think many of the students here are looking for a job with a big firm and trying to learn. And maybe on that part, what do you think are the important kind of traits that a good analyst should have?
Now, a good analyst needs to be a salesman for the bank. So you need to do good projects that look good and that make the bank look smart. If you look at S&P 500 projections for 2024, all bank analysts said the market will go up 10%. Why? Because that sounds good to all their clients. Everyone said it will go up 10%. If it doesn't go up 10%, then you say, oh, everyone said it, it's not me that was wrong, and you don't lose your job. If you are an independent thinker, then you say, okay, the market will go down 30%, it doesn't go down 30%, and you lose your job. So you need to be a conformist to work for an investment bank. You need to attract clients. You need to say the words clients want to hear to stay with you, and promise them something so that the bank gets that 1, 2, 3% fee of the clients. Because I don't think that anyone in the sane mind would tell to clients, oh, invest 40% of your portfolio in bonds offering 0.3% yields with inflation at 2%. That's not something that a person with character or moral or ethics would do. And therefore, okay, yes, it's very nice to have a big job at, I'm going to say it and then you might write me off. I remember when I was looking to get a job at Goldman Sachs, I was going through internet and I was going, okay, how to get the job, how to pass the interviews, how to pass their tests. And there was a comment by a guy, why would you want to get a job at Goldman? And someone replied, well, it is a great job, a great company, it gives you respect, etc., etc. And the replies was, if you get a job there, you will lose all your personal respect. So maybe it's not something that you want to hear, but I'm the independent guy that can say anything.
Yeah, no, we actually like to hear that. And many of the students here are pursuing jobs in the buy side. So many of them already were at Goldman Sachs and maybe lost their personality there. So they are looking at the buy side, in which I believe, I want to believe that maybe incentive alignment is a little bit better, because we definitely understand what you're talking about in incentive misalignment, because you want to increase your assets under management, and you want to do everything you can to keep your clients, and so you have to be a salesman. But many times, when you're an analyst in the buy side, you basically work for the portfolio manager, and now you need to sell him your idea or her, right? So you have to do very good research, and of course you also have to sell your idea. So you have to have a story. So however you want to look at it, right, you have to have a good story for this talk, or this name you're researching. But I wanna touch a little bit more about the technical skills of the analyst, of the research analyst. What are the things that in terms of skills you think are important? Is that consistency? Is that the depth of the research? What are kind of what's your view about research specifically?
I think that, well, we all have the numbers. You put up your terminal or whatever, you get everything out there. So the quality lies in seeing beyond those numbers. So understanding how will this look like after the cycle has passed. For example, another market infatuation was lithium a year or 2 years ago. But if you look at these cycles and commodities, and then analysts were saying it when stocks went up, all analysts were saying stocks were a buy. Now that stocks are down, going down, all analysts are saying it is sell, except for the Goldman Sachs analyst that was always saying it was a sell. So kudos to that Goldman Sachs analyst. He had character. So, and then you need to know, okay, what will happen? High prices in commodity environments lead to high investments. High investments lead to oversupply, which lead to low prices. So you have to think more long term. The market, analysts and everything always think myopic. If you listen to analyst questions, it's always about the next quarter because they need the data for the next few quarters to put in their models, and then their models are usually linear forever. Or they say just 2 years and that's it. So if you want to give a good idea to your investment manager, if you can find value beyond the 12 to 18 months that analysts look into, then you can say, look, the analysts are missing it because this will do better from month 24 onwards, and the analysts are not yet seeing it. Or it will do worse, and the analysts are not yet seeing it. So if you can see what the market is missing, then you are actually creating the value.
Yeah, that's a great point, I think. And you also, we have to recognize the fact that this portfolio manager, right, they also manage money. And as you said before, they have trouble with looking. So what you're talking about is kind of an arbitrage between the long term and maybe the medium or short term, right? Like, I'm going to invest for a longer term, and that's why I have an edge, because I can sustain maybe the volatility or whatever. But these portfolio managers or fund managers, partners, they're also measured usually, year by year, maybe 2 years. And so they have the risk of money being pulled from their fund. And so this is why I understand, there is this incentive misalignment. So how do you bridge that gap? Because the analyst, in some sense, has to give ideas that will create value within the next 24 months. The average turnover is, of course, usually even below 1 year in most of the active funds. And so how do you bridge that gap?
The only answer to bridge that gap that I found was done by Warren Buffett in 1968. He closed his fund partnership, owned his own business, and here, you'll have a letter once a year and let me do my job. And that's it, because once you start competing on that yearly basis, I think you are lost. Or you are Druckenmiller that can compete on that yearly basis. But what he's doing is something very peculiar that retail investor or pension funds investor can't really do, bigger funds or something like that. So there is no answer, because if you are not performing 1 year, 50% of your money leaves. When I have a year on my research platform, 1 year, that my ideas underperform the market, I lose 50% of my new clients. That's it. So if you run 100 million and you underperform the S&P 500 for 1 year, you lose 50% of your clients. And you still need to pay your research, your this, your that, your left, on your right. And then you start chasing, then you start taking more risks. And when you start taking more risks, you usually lose everything, and then it gets ugly. So it's either you manage your own money, so you don't have outside influences, and that's it. And how, or you make something like Seth Klarman did, family funds, a few families that really know, okay, this is it. We do this for the next 40 years. Whether we outperform the market or not doesn't matter. We want the value to be created from the portfolio. And if you can sell that story, you will find a few clients, and that's it. Minimizing costs so that you don't have to sell out after a bad year or something like that. So always be prudent, be a value investor, don't do stupid things. And the key focus is to survive those ups and downs. If you can survive the downs, then you'll do great in the ups.
Yeah,
But
so
there
in
is no
some-
answer. I don't know whether I will outperform the S&P 500 in the next year, 1 or 5. I know that my value investing strategy works over a life cycle, and that's it. The more I cannot.
So you tend to keep it simple, and I think that's great. I think it also echoes kind of what the late Charlie Munger like to say. Avoid stupidity or stupid things, right? Avoid the risks. With that, I want to open for questions from our other students. If anyone has a question, then Sven is here. Anyone?
One mic.
Right. No, I think you can hear. Yeah.
Hi. Can you
Hi.
share with us, Roy from Israel? Can you share with us like a mistake that you have done and how now in hindsight you can avoid that?
So a mistake, I would say that as the last 10 years were all about growth stocks and everything will grow and grow, then I also put in too high of growth rates when I was analyzing companies, for example, 2 years ago. Of course, if Amazon keeps growing at 15%, then it is very valuable. But it is not growing at 15%. If we have a recession, on average, it will maybe grow at 5, 7%. And that was a mistake that even I fell into the growth trap. And then those small changes in growth, the delta of the delta. So if the growth slows down, the valuation diminishes, and that has a huge impact on stocks. So that's a mistake that I made as an analyst, for example, over the last few years. I was too exuberant on the growth.
Alex, you have a question? Okay.
Okay, well, thanks, Sven. Thank you for speaking with us today. And I'm really glad you talked about CK Hutchison and also about Hong Kong stock market. I came from China, so I've been spending a lot of time looking at companies in the Hong Kong stock market recently. And you must know it's been underperforming for a couple of years, 3-4 years. And what do you think might be a catalyst for the market to recover? Do you think it's a Chinese recovery story, or do you think asset and money will start to reallocate to China or Hong Kong in the near future?
So for now, Chinese stocks are going down. So people are selling like crazy. A friend of mine from Hong Kong used to say that people in China are gamblers on the stock market. Long-term holding is over the weekend. And then also everyone, when you see a stock going down, only bad things happen to your mind. So also the headlines, everything is extremely negative. But at some point, those headlines cannot continue. And at the point of maximum pessimism, usually things start to turn. That can be better economic news, growth in the businesses. Even if many businesses are growing, they're paying huge dividends. And at some point, people will start to recognize that. And then we'll have, again, stocks going up. Stocks going up means positive news, upgrades by analysts, etc., etc. And then you have all that cycles that in China, Asia happen every 5 to 7 years, like clockwork, the last 20 years. So it's not really some catalyst, but just at some point the bad news will run out, and after that, better news will come in.
Actually, let me follow up on that question. Like CK Hutchison has always been kind of stock that trades below book. A huge part of the business is all diversified. There's a massive holding discount because the controlling shareholder runs everything. And they, generally speaking, wouldn't be giving you the assets right away. They will be doing transactions, get some cash on the corporate level, buying some assets in the UK and stuff like that. So how do you balance that? I understand it's a cheap time in the market when most of the opportunities are cheaper. But is CK Hutchison the best way to express that view? Or would you be choosing something?
I haven't bought CK because they said that they will be focused on lowering debt. And they are really working on that, putting the money on lowering debt, which is something the market doesn't see. But if a company lowered their liabilities by 30% in a few years, that is value created for the shareholder. And when it could turn is when they say, okay, we are fine with the debt level, we will start doing buybacks. And usually you can read that through conference calls. That's why I started just following it. And if I can catch it when there is a clear catalyst, like, oh, this company will start doing buybacks in the next 6 months or something, they will announce it. You will see maybe the stock price jump 4%. But as they start doing buybacks, then it can go higher and higher. That would be a catalyst for an asset value play like this company. But of course, I didn't see the catalyst yet. I will follow. If I see it, great. If I don't see it, I follow 50 businesses. I just need a few of them to understand and find that catalyst in place.
Hey Sven, thanks for speaking with us today. My question is, what's your favorite off the beaten path for finding interesting investment opportunities?
Off the beaten path?
Yeah.
So I started investing in a frontier market. I actually come from Croatia, and nobody was looking at Croatia in 2002. I found a stock that was owned by Ericsson in Croatia, and the dividend yield was 33%. Of course, in a few years, the dividend yield went from 33% to 3%, and I made 10 times my money. That's how I started looking at cheaper stocks and yield, of course. But off the beaten path, you must to either look at things that others are not looking at. Like I looked at lithium now, but I see everyone is predicting oversupply for the next 4 years, which usually means that the oversupply will be there only for 2 years because nobody's going to invest into low lithium prices. And off the beaten path is either finding something that no one is talking about, that no one is seeing, or looking at things with terrible pessimism at extremely cheap prices, like not yet lithium, but maybe in a year. Because if you follow what everyone else follows, you will always have average returns.
Thanks. And just to clarify, so that example of the 43% dividend yielding stock, did you come across that via just a screen using financial software, or how did
I looked at every company traded in the market one by one, analyzed everyone, selected 2 of them, and one did 14x. I sold after 4x, so I missed the 10x later, and the other did 10x as the business was recognized as a good business.
Nice.
But I usually go one by one, because if you use a screen, you look at financial data usually shows you the past, while you invest in what will happen in the future. So you need to know the story. Why is that? What going on? And then you're trying to find inefficiencies. Speaking of commodities, you do a commodity investment when the financials look terrible. You invest in a copper business, in something like that, when they are not making any money, because that means we are at the down point of the cycle, and then in the future they will make money as high cost producers close down, etc. But if you buy a company like, I don't know, car companies in 2022, they were trading at P ratio of 5 and dividend yields of 8%. The financials look good. They are flushed with money. And then 2024 comes, car sales go down, everybody's losing money, and the stock goes down. And then that is the cycle you can follow. But if you screen for that, you will only screen for good things, and you will not see those businesses that have not so good financials, but good future financials. And I think that is why Warren Buffett says, start with the A's, and then you learn about businesses, you read about, and then you understand how businesses are doing, how they are going, and then you can see those advantages that other people don't see.
Right, thank you.
Thanks for taking the time to talk with us. I have a follow-up question, because how do you balance value or valuation versus the fundamental or the quality of that business? Because currently investors have become very sophisticated. A business with good fundamentals or good moat usually don't go to that kind of low valuation situation. Or those companies with very low situations, very low valuations, probably going through some kind of distressed situation. How do you know it's not a value trap? How do you know it's gonna get better in the future?
That's a good question. And for example, the Magnificent Seven companies are all great businesses, amazing businesses, from Google to NVIDIA to Amazon. Those are all great businesses. And of course, their valuation will be higher because of their position in the market, etc. But there is always the risk, what if that valuation contracts? Because even those great businesses get to some issues. So it's very hard for a value investor to invest in such businesses. Even if Meta was trading at a P ratio of 10, I think it was 13, 14 months ago. So Amazon, if you look at the value of infrastructure, also was trading very cheaply last year. And on the other side, you have cheap things. And whether it is a value trap or not, I think that is in the time horizon. That, okay, now something can be cheap, but it can also be a trap. But if you figure out that in the worst case scenario that you can think about, you still do good, then that is a value investment. So even if the worst case happens, there is still value at the end of the process, more value than you paid for. Then whatever happens, you don't really care, because you know that you have value, and over time the value will emerge somehow. But of course, it is 1 out of 1,000 investments that I look at, that I start following and investing.
I think we have time for one last question.
I'll try to make it good. Thanks for coming to speak with us. There's a question on your YouTube channel. I was wondering if you notice any correlation between the comments and the ideas you share. Do you think there's a negative correlation, the better idea, the worse the comments is, or something like that?
I have the beginning, everyone wanted me to talk about the cool stuff. And then when you talk about an analysis or some unloved sector, then the views go down. But it's not about the views, it's about the viewer. So I prefer to have maybe lower views and talk about an interesting subject that's related to what I do. rather than to chase views. Of course, you try to balance it a little bit. You try to discuss why this is not a good investment, even if it's hot, but you try to balance a little bit on YouTube with interesting things, try to turn them into a value educational way, into something that might lead to long-term value investing.
That's great. So I want to thank, first of all, all the students that came. Sven, you don't see there is another side on each side. So we have around 50 students here. And of course, I want to thank you so much for your time. What time is it now for you?
No, it's just 7:30 in the evening, not late.
So it's not too bad. So really, thank you so much for your time, and we enjoyed the conversation. And yeah, we'll keep following the YouTube channel and the things you do. We are really thankful for that. And that's it.
Thank you for having me. I will upload this on my YouTube, so 20,000 people will see what you asked me.
Perfect. All right,
Thank you.
Thank you so much.
Bye.